that should work. Sweet.
Hell yeah, dude. All right.
Sweet. Can you see me and hear me?
In maybe just a second.
Okay.
This is gonna be sweet.
Nope, I can see you.
Sweet. Can you hear me now?
Turn it up.
Sweet.
So we have like a 30-second delay, 10-second delay, so you're good.
All right, guys, I'm about ready to start and get everything rock and rolling. I appreciate you guys all tuning in for me. And so one of the things I really wanted to kind of focus in on here is we've had a crazy 2020. I mean, it was insanity. I try to do my best to spend a lot of time studying so I can kind of relate it to you guys to basically know the best ways to kind of overcome objections with buyers, overcome objections with listing agent, or on the listing side with presenting to you, obviously trying to get people to bring their inventory onto the market. I know you guys get a lot of questions from real estate investors, and you get a lot of people that just for wanting to know kind of your own. And so what I'm going to show you guys is kind of reveal my bag of tricks, everything that I've been personally kind of studying over the last several months. And basically I'm going to bring you guys some hot stuff once a month on this. That my goal is just to basically help you guys close a lot more deals, or for investors, obviously kind of know where to pick your markets. And so I'm going to really kind of dive in today. It's just kind of get everything launched off. It's kind of 2021, where we're going. I've been lucky enough, knock on glass, to nail my predictions. You know, when I was screaming, we're going to see house prices go up when we were in the midst of COVID, everyone thought I was crazy. I got the most nasty messages from people, and here we are. You know, we finished out the year 10% year over year price appreciation. So I'm going to dive right in for you guys. I know a lot of you guys have got busy schedules, so I'm going to kind of walk you through everything on my screen. So everything that, obviously, there's no secret right now where house prices across the country have gone up. And there's no reason on why they haven't gone up other than the simple fact we do not have enough supply of homes. We have such a shortage of homes in the market. It's absolute insanity. I'm going to show you in the next couple slides, and I can share all of this presentation with you guys so you guys don't have to try to run through all the facts right offhand. Now, we've seen 10% price appreciation in most markets year over year. Some we've seen high as 15 and 16%, and some on the lower end sides, we've seen only in single digits in most markets. Now, obviously, in some of the major markets like New York City, San Francisco, Chicago, and certain pockets of that, we have seen a little bit of a decline. But overall, here specifically in Southern California, we saw 10% price appreciation year over year. Now, I do not want this to be something that is, and people have to understand there's bulls in the market and there's bears in the market. Bulls, think about it when you're thinking of that, and the best way to remember it is think about a bull. Bull, when they charge, they throw their heads up. So a bull wants the market to go up. A bear, when they strike, they slash their hand down. That means the market goes down. So you got bulls and bears of everything: stock market, real estate markets, crypto markets. So I am not going to be a big bull in this market. I want to give you both sides. My goal of this real estate forecast is to be an umpire. I just want to call it as I see it and not be on either side. Now, we have some major obstacles that are going to hit us in 2021. And I'm going to go through those in detail, between the massive amount of businesses that are going to fail, the large amount of landlords that are going to have to probably put their properties up for rent. We're going to see a large number of individuals that truly can't afford their mortgage when they're getting out of forbearance, even though it's not this big gloom and gloom number that everybody's seeing. And then obviously too, I want us to keep in mind that everything, when people try to pull in politics, they try to pull in everything. The market in real estate is simple. It functions by supply and demand. Very simple. When supply is very, very high and it exceeds demand, prices drop. When demand is high and supply can't meet its need, prices go up. It's as simple as that. And the one thing you have to understand, if you remember nothing from this but this, supply will always follow demand. It comes on the heels of demand. So meaning this, people understand that, hey, you know what? There's a massive, massive amount of demand for houses up there. Shoot, I want to probably list my house and get it onto the market because I want to take advantage of this great market. But we have an event going on in this world, and we have for the last year, that's really limited that, because people are very afraid to still list their homes for sale, or people are unsure where they're going to go. That uncertainty is what is causing this massive, massive shortage of inventory. And it's going to get better. I'm going to follow you guys through on some of these slides. I'm going to walk you guys through details of it. And I do have my two awesome assistants that are manning chat. So if you guys have questions, you can drop stuff in chat. I'll respond to them. So first and most importantly, I get this question all the time. When are we going to see more houses come to market? Now, I want to phrase this for you guys. This part, I'm going to talk to people that either one, are sellers, or two, individuals as realtors that you guys are trying to get people to list their homes for sale. Okay, this is very, very important because we are going to see a lot more inventory coming to the market, and we will see it this year. And it's broken down into 4 simple facts for you guys. Very simply put, remove your political agenda from it. The simple fact is shots in arms mean more houses to the market. Like if you just remember that, the more shots we get into arms, the more houses we're going to get into the market. And that specifically is, so to give you guys an idea, in 2020, there has never been fewer homes sold in a demographic age range of 65 and older ever. That means fewer people at 65 years and older sold their homes. Never has it been this low of a number until last year. And it was like 35% lower than any other previous year. So what does that tell you? People that are 65 and older who are feel very, very scared about what's going on did not put their homes for sale. Now that is hugely a problem because what people have to understand is baby boomers right now, the average age of a baby boomer is 71 years old, okay? Baby boomers, they were the largest population that has ever existed until millennials right now. Now, they have massive, massive migration patterns, right? Once they start getting their Social Security, like my in-laws hit 65 and 66 years old. What did they do? They sold their house in Texas where they had lived for 40 years and they went to Florida as soon as they retired. Now, they were one of the few people that actually still made that, and the only reason why they did it is because they did it before COVID hit. They sold their house at the beginning of January, February of last year. Now, that migration pattern, those houses that hit the market are a massive supply of first-time home buyers and investors because a lot of those people are living in 3-2s or they're living in 4-3 homes. They get rid of their house. They either move into a retirement community, they move into a condo, they move by the beach. We never saw that inventory. So once we have all that pent up demand from all these baby boomers that when they're getting their shots in their arms, they're going to list their houses, okay? So we are going to see a decent amount of inventory hit the market, but it can't come fast enough because we're just not going to get enough shots in the arms as fast as possible. But they do expect that by July, that anybody that is 62, I think it was 60 or 62 years or older, will have the opportunity to get vaccinated, both the full vaccination, because you got to get 2 shots, I believe. My grandma actually just got it and she's 81. So that will happen. So second half of this year, we are going to see that inventory hit the market. So keep that in mind when you're basically kind of educating your clients. The reason why I bring this up is because you don't want to follow the market with supply. So what you want to do is to maximize your price as a seller, you want to get that house on the market now rather than when you're going to get the glut of inventory. And I don't say a glut in all markets. But there's a large amount of inventory that's going to be hitting the market for these baby boomers when they get shots in their arms. Now, the other thing, part 2, we had this huge, if you guys aren't familiar with it, the eviction moratorium. So I'm a landlord. I own a bunch of properties. Fortunately for me, all of my properties for rental properties were in Tennessee and Texas. And I've been lucky that everybody was paying their rents on time. Now, what they did here specifically in California is Gavin Newsom extended the rent moratorium, okay? And you can see it on your screen till the end of June. And he did something very unique. And it's very, very important you guys understand this. So there's 2 parts of this bill that passed in California. The first part is they will give tenants who can sign under the penalty and perjury of law that say, hey, I was affected by COVID with my income. They will give them money to pay the landlord. It doesn't go directly to them. They will give money to them to pay the landlord so they do not have to pay rent through the end of June 2021. Now, landlords, if they agree to take a 20% haircut based on the lease, right, of the rents that's owed to them, they will be able to get 80% of their rent covering, as you can see right here on the screen for you guys, from April 1st of 2020 to March 31st, 2021. So that year long of rents, they will give landlords 80% of the back rent owed if they agree to take a 20% haircut and their tenant shows that they have not or they have been affected by COVID. So where does this leave me? Is one, what's happening is people aren't moving right now because why? Tenants are sitting put and they're not moving because they're not having to pay rent. And investors, many times they're in forbearance. If your tenant's not paying the mortgage, as an investor on that mortgage, most of them are in forbearance. So they're not having to pay the mortgage payment. So we just kind of have this like state of everything up in the air. Well, this is going to come to a reckoning. And what's going to happen is as these leases expire, you're going to see landlords, you know what? I'm kind of concerned that Biden may raise the capital gains tax. You know, I've had a great run on this property. Let me just take some chips off the table. I'm going to put this on the market. Or, hey, you know what? As this, I can't evict them, but guess what? When the lease is up, you know what? I can get them out of the property. I'm willing to take 80% of the rent. I'm done. I don't want to deal with this. And they're going to be able to do it. So that inventory is going to start trickling in that second half of the year. And that's a lot of homes right now that are not being sold or put on the market because everything's up in the air and the landlord's not having to pay their mortgage. So the tenant not paying their rent isn't really affecting them yet. Now, the third thing is mortgage forbearance. Now, mortgage forbearance was once again extended. What that means is you don't even have to do anything really, but if you basically decided, hey, I don't want to pay my mortgage, you know what, I'm going to sign up for forbearance. And now it's been extended all the way until March 31st of 2021. Now, it's very important to know that 5% of all mortgages are in forbearance. Now, obviously, you know, I own and run a mortgage company. So I get contacted all the time for people running to refinance. Now, probably 25% of the people that are contacting me to refinance are in forbearance. If they're contacting me to refinance, they don't need to be in forbearance because they know if you have to refinance, you got to at least have a job. So that means of that number, there's a very, 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 very large amount of individuals out there that are not paying their mortgage payments. And what are they doing and their job in many cases has not been affected. And what are they using with that money that they thought they would have to pay their mortgage with? They're spending it. You wonder why retail sales are super high. You wonder why auto sales are super high. You're wondering because people have this disposable income that is not being allocated towards their most expensive debt, right? Their mortgage payment. So when that stops, I do see a pullback in retail spending. I do think that the second half of this year isn't going to be as bright and shiny as far as the economy goes as everyone's like to kind of paint this picture. Now also, when that mortgage forbearance starts to end, servicers under Biden's order are going to be forced to do everything they can to keep that person in the home. So these foreclosure waves are not going to happen. They're not. What's going to happen is people are sitting at an all-time high in equity. I've discussed with a lot of you guys that are on this, the average loan to value, meaning loan amount to the value of a home, is at the lowest point it's ever been in recorded history. It's at a 56% loan to value. That means people have 44% of the value of their home in equity, meaning better split. If somebody has $1 million home, the average loan amount on it is $560,000. So they're sitting on an insane amount of equity. So people, if they feel like they've been, you know what, I'm really kind of uncertain what's going on right now, my company's going down, or I'm going to have to take a pay cut, this and that. What are they going to do? They have all that equity. They're not going to foreclose on it. They're going to put that house up onto the market and they're going to sell it. And I'll be honest, I know a lot of people just from kind of the audiences I have in different social media that have reached out to me that are going through hard times on that kind of stuff. And that they are going to be planning on putting their house on the market because they are in forbearance and they need it. So we are going to see that inventory come to the market. Now, is it going to be some mass foreclosures? No, it's not. You know, you figure in this way, there's roughly about 4 million mortgages that are currently in forbearance right now. Let's say of those, 20% of them hit the market, okay? And I'm going to show you guys here on the slide. So let's call it, just think in your mind, we're going to have about 800,000 homes potentially hit the marketplace sometime this year related to the forbearance stuff, okay? Now, as I said, obviously people are hurting, kind of coming right now to the next slide. Now, this is something for here specifically in California. Is everybody leaving California? No, they're not all leaving California. So one of the cool things that I actually follow is John Burns Institute and Black Knight. And now, believe it or not, yes, we definitely have people leaving California. And for the first time ever, we have more people leaving than coming. But 72% of people are moving within the same state. 72%. And I'm going to show you guys here in a second what's happening. There's basically 3 hot spots in California where people are all kind of moving to. And I'm going to show you guys here in a second. So why? Because obviously people are realizing they can work remotely. I'm going to show you guys on a slide here, but prior to COVID, there was 15% of people that were working from home. Right now, there's 37%, and they expect about 30% of those people, 30% total, to be able to be allowed to work from home. So honestly, that's double the amount of people in the United States that are going to be able to work from home. If you can work from home, you don't have to worry about being so close to your work. So many people are around those metro areas because they had to. Now they don't. I mean, I have about 12 of our employees that are working remote, and to be honest, the production's amazing. There's if anything, it's a little bit better, as far as that goes. So I think a lot of employers are going to realize that. Now, one of the things that's really cool, and for everybody that you guys, as business owners yourself, you guys want to write this down. So for the first time ever, I mean, and I hate Gavin Newsom, and there's no secret of that. I mean, I think he's a clown. I think he's terrible for the state of California. But there was one thing, and he didn't do it, but it was just been now more money is being put behind it from federal funds that's coming for some of these stimulus. It's called California Competes. So what it's designed for are companies here in California that are staying here in California, or people that own a business that want to move to California, and you hire and you have a growth plan, and you submit that plan to the Franchise Tax Board, get with your CPA. My CPA is the one that provided it for me. They will give up to $180 million in tax credits. So what that means is let's say, for an example, I show that, hey, you know what, I have 40 employees now. I'm going to hire 60 employees by next year. This is what the employee makes. This is how many hours they're going to work full time. They analyze it and they give you a tax credit that you can apply to your 2020 tax bill going forward. So they are realizing, shoot, businesses are leaving. This is scary. So that's probably the only good thing I've seen California do in a really long time. So yes, California is doing something about that. It's called the California Competes Tax. Let's see.
All right, it's connecting now.
Let's see if it works.
Yeah, we're back.
Cool.
Okay,
So
you're
go back to
Sweet.
You're on. You're live.
Okay, sorry about that, guys. We have people downstairs doing work on our the downstairs office, and it looks like they messed up something with our internet. So what I want you guys to show you is this website, and it's called How Money Walks. So what this specifically is an exact migration pattern. So use this. I've showed a couple of you guys this. This is one of the coolest things you can see. So it's really focused specifically on showing households. So every household has an annual AGI, an annual income. So let's just pick a household. Let's just say a household has $100,000 of annual income they file on their IRS tax returns. And what do is those tax returns that is tied to somebody's address, and that address is filed with the USPS. So they know that if Brian and Allison Decker make $100,000 a year and we live in Murrieta, and we do a forwarding address with the USPS to Boise, Idaho, that gets triggered. The IRS knows and tracks that $100,000 of household income has left Riverside County and is now moving to Boise. And this was tracked all of last year. Now, what this map shows is you can see red and green, right? So the more red it is, means the more money that's left. And you look at the more green it is, the more money that's actually come. So you see lots of green here, except bright red over here, bright red through here. What it means is if your state's red, that means more than $15 billion of wealth annually. That's not like net worth, that's annual income has left your state. Now, what's cool about this is you can drill it down. So what I want to show you guys here very specifically, remember I told you there was a couple really cool little hot spots in California. Now what I want to show you here, look at what's happening. So if I break everything down, I like to divide California in thirds. We got Central California, we got Northern California, we got Southern California. Now, Riverside County, and I've always said this, I was born and raised here in Temecula. I left Temecula. I lived in Orange County, LA County, and San Diego County as an adult. And my wife and I obviously brought our kids back here about 5 years ago into Temecula. And nobody ever understood this. And I told all of our friends and family, Temecula has our area has the very, very best school districts that are in the area. We're surrounded by 3 of the most expensive counties in the entire country, and we're way undervalued. If Riverside County was a stock, we would be trading at like 10 times our price earnings ratio, and LA County, Orange County, and San Diego would be 50 times, meaning we would be such an undervalued stock, right? So what's happening is now this is finally starting to happen. So what you can see here is, look at this bright, bright green thing. This is Riverside County. Riverside County last year gained billion worth of wealth moving here annually. That's $15 billion of household income came into Riverside County, more than what was left. So in essence, say there was $10 billion of wealth annually leaving, we went ahead and we gained $25 billion moving in for a positive of $15 billion. And what's cool about this site tells you exactly where we're gaining wealth from and where we're losing it. Now, what's very, very, very important about this, look, we knew where we were gaining wealth: LA, Orange County, San Diego, San Bernardino, in the Bay Area. Why is this so important? Well, look, how much more house prices in LA County than Riverside County? How much more house prices in Orange County than Riverside County? How much more in San Diego? Why? Think of every home buyer as an avatar. And if I live in LA County, I'm used to seeing multi-million-dollar house prices, $4,000 a month for apartment rent. Now all of a sudden I can work remote and I'm moving to Riverside County and I'm looking at school districts and shoot, I can afford a $700,000 house gets me a 4,000 square foot house. Are you kidding me? This is insane, right? It's that shock of a buyer. They can't believe what they can get for here, and they're willing to overpay it even by people's resident standards here, right? So you have to look where people are moving into your area from. And where are we losing money to? Obviously Arizona, Nevada, and Idaho. But look, the biggest out thing of Riverside County was to Maricopa County, so called Scottsdale area, Phoenix area, that whole area. There's only $400 million of wealth annually that left. I mean, look, we gained $3 billion just from San Bernardino, $3 billion from San Diego, and you can use that. So what's happening is, and why Riverside County, even though I'm not super bullish about home prices in 23 and 24 across the country, I'm very bullish about house prices here in Riverside County over the next couple of years, because our buyers are coming from areas that are so, their threshold for thinking something is expensive is so far, right? People are they're never gonna come here and they're gonna think, oh my God, I can get that for 800 grand, and they're looking at that would be 2 million at home. Prices can still go up here a lot for them to realize that's a little pricey for Temecula and Murrieta, right? So you see all of that. And we look at San Diego County, right? San Diego County, to be honest, it was neutral, in my opinion. They only lost 135 million, right? So it's pretty neutral, meaning as many people are leaving as going, because obviously their weather, they have a great economy, and you can see where they're coming. Everybody from LA, Orange County, the Bay Area, Chicago, are all moving down there, right? As I said, 72% of people are moving within their state. Where they lose money to? Look at that. They're losing it to us here in locally in Riverside County. $2.7 billion of wealth moved from San Diego to Riverside County. Okay, a lot. Way more, triple anywhere else, right? And you can go through this. And so we have hot pockets. You're going to see San Luis Obispo. So we have this whole area, Ventura County, LA County, Monterey County. They're all moving and they're going to San Luis Obispo area, right? That's the little hot pocket up there. And then once again, I have a lot of friends that are in the Sacramento markets. They're getting so many people moving from San Francisco, Marin County, all of those areas, Seattle, and moving in to Sacramento County and that surrounding areas. Once again, completely pumping up those values there. So these are some of the hot spots in California when you are looking at going to see what you can, obviously, for investing and advising your clients. Now, I'm not saying if you're in Orange County or LA County, you're screwed, but don't really be advising your clients that prices are going to be able to continue going up at the same rate, because once inventory hits that market, the supply that hits it, there's not going to be the same demand there as there is in certain areas like Riverside County, San Luis Obispo County, Monterey, and those areas, right? So once again, a really cool website, specifically using it to when you're looking at talking to your clients, especially on listing sides of things, and seeing where their buyers are coming. And that's why you can explain to them your marketing. The reason why I'm marketing and spending a bunch of money in LA County, Orange County, San Diego County is your buyers here. This is where they're coming from. You know what? This is why you want to use me as a listing agent to be able to go ahead and actually market to these areas, because that's where your buyers are coming from. Your buyers aren't, a little bit are going to be coming here from within Riverside County itself, but that's why I'm really marketing to those specific areas, right? Okay, now what I want to be able to do is I'm going to go back to my slide for you guys. Give me 1 second. Okay, so now what I want to talk about real quick is mortgage rates, and I'm going to go through this quick. So mortgage rates, just so everybody can be very, very clear, the lowest that mortgage rates will ever be is behind us. So mortgage interest rates bottomed in November and December. Now that the 10-year treasury, so everybody can understand this, is what happens is interest rates that the U.S. government has to offer for their debt, okay, people, they have to increase those interest rates so people want to buy it, okay? Because not a lot of people are buying it. They got to raise their interest, which affects mortgage interest rates. Now, the interest rate yields, 10-year yields on your bonds right now at the U.S. are higher today than they were before COVID started. Now, reason why mortgage rates haven't gone up, that they haven't, that same factor, is because the U.S. government is buying so much mortgages right now as part of their stimulus, it's keeping rates down. Now, rates are not going to go through the roof, but interest rates will end this year higher than where they started. Mark my words. Now, where do I think that is? Probably 3.25% versus being 2.75-ish today. So interest rates are only up about 0.25% from where they bottomed out at the very end of last year. And what does that make as a difference? So you're talking, to give you an idea, a 2.75 rate today compared to, let's say, a 3.25 rate. It's only $100 on a monthly payment. So it's not going to make or break it. People are not going to really kind of put their foot on the brake on buying houses until interest rates psychologically go around 4.5%. But one of the big things I do recommend, as I said, when you're talking to sellers and trying to get them to list, let them know they want to beat that inventory that's going to come to the market. The more shots we get in the arms, and once all these different types of forbearance periods end, they're going to get, in my opinion, I think that they're going to get the biggest bidding wars, and they're going to probably get top dollar in the first, between now and probably April, May is where we're going to see kind of top dollar, I think, this year hit, and the biggest demand and biggest foot traffic. After that, I think prices are still going to finish out the year up from where they started, but I think it's going to peak and then kind of settle back down and finish out the year here in Riverside County, maybe up 3 to 4%. But I think we can get as high as 10% over where we started at the beginning of the year by like March time, with such little inventory hitting that marketplace. So interest rates are going to be staying low for a while. Now, real quick, how do I get this data? I like to show you guys a secret. Very, very simple. Think about it. When people go ahead and they're going to move or they're going to leave somewhere, what do? They rent a moving van or they rent a moving truck. So it's really cool. U-Haul, United Van Lines, all these things, if you just Google them, they give you all the information about where people are going to and from. So why do I say this? Especially for your investor clients, it's really good to have this information. Hey, you know what? You probably didn't know the top 4 areas that people are moving to in those areas. And a lot of people are going to go to a place to rent before they buy a great investment property area, get in connection with a referral realtor that you can get some commission back from them. Here's where they go. These are just a couple of them. The top 4 were South Carolina, Oregon, South Dakota, and Arizona, that had more people inbound than outbound. The most outbound, no surprise, New York, Illinois, Connecticut, and California. Now, I am super bullish on 2021 and 2022 for home sales. And I don't think house prices are going to go up quite as much as they went up last year, especially when you get a little inventory. But 2023 and 2024, they will be good years, but they will not be, in my opinion, as good as the 2021, 2022. And why? Because a couple things are happening. And what you need to understand is the difference between a trend and an event. An event occurs, right? A trend continues. So it's like a one-time thing, right? Like an event is Super Bowl, right? NFL, the season, okay, it's a trend in essence. You have multiple games that come in there. But the Super Bowl is an event. What we're experiencing right now is an event. We are having right now people migrating. They are getting out, realizing they can work remote. They are making a move, and they don't plan to move at the same time. We're getting all these millennial buyers, the greatest amount of individuals of home buying age that have ever existed, all hitting the home buying age right now between 2020 and 2024. That, compiled with low interest rates, compiled with the shortage of inventory, compiled with COVID, is causing this migration event. Now, you guys, and like I said, you guys can see this on here, but home sales in 2021 are going to be better than 2020. Home sales in 2022, they're going to be good. I think a little bit less than 2021, but house prices will be pretty stagnant in 2022 with some of the inventory we get. Now, like I said on here, one of the biggest things that I really think people need to be aware of is 30% of small businesses did not renew their Yelp subscription. So if you think about it, if your business is not going to be doing well, you're not planning on keeping it, first thing you cut is marketing. So Yelp, small businesses, 30% of them did not renew or do not plan to renew this year. So that is a massive. Now, given Yelp has a lot of restaurants, they have a lot of hospitality stuff, but that is a scary thing. And the unemployment rate, which I'm going to get into here in a minute, is showing that, like I said, a lot of this migration is causing this housing. And a lot of the same time, the demographics of people reaching home buying age and wanting to buy. This is not the economy is just booming, and that's why people are wanting to buy. So don't make that mistake. Don't think this is the greatest economy we've ever had, and that's why housing is doing great. No, we have the largest group of people reaching home buying age, why interest rates are at the lowest, why we had COVID as an event, all making this massive event that we're probably not going to see again in our lifetime. And it's a chance to make a heck of a lot of money right now, but don't think that you're going to be able to be continuing this for 5 or 10 years into the future, okay? Now, I want to show you guys something else right here on unemployment rates. Okay, so a couple things real quick on unemployment rates. So first off, what you need to understand is unemployment rates, do not believe what they tell you in the news. They are skewed unemployment rates. Somehow, the unemployment rate dropped last month, and people are like, how'd the unemployment rate drop? That's crazy. Well, you know why? Because 5 million people are not looking for jobs anymore, okay? So the unemployment rate is the percentage of people that are employed compared to the percentage of people that are trying to be or in the workforce. So meaning if I have 100 million people looking for jobs, okay, and I have 5 million people not having jobs, of the 100 million that are actually able to be employed, I have a 5% unemployment rate. 5% of the people don't have work of that. Now, what happens if 10 million people decide that they're not going to get into the workforce anymore, right? What happens? Well, guess what? Those 5 million people that you have out there that don't have jobs, right? Let's say of those 10 million that left, 3 million were in that bucket. So now I only have 2 million people looking out of 90 million. My unemployment rate dropped. So the unemployment rate is the most skewed up, screwed up thing you can ever have out there, because if you're not actively seeking a job, they don't even consider you in the unemployment rate. So that number is completely wrong. The real unemployment rate is probably around 11%, because like I said, there's 5 million less people being included in that number than there were pre-COVID, okay? Now, this is really important. So as you can see here, the unemployment rate is the lowest among millennials. And I don't think I have the statistic on here, but the unemployment rate is only about 3.5% between people the ages of 22 and 36. It's the lowest ever of anybody out there. Now, obviously, if you don't have a high school diploma, obviously the unemployment rate's way higher for you, but those are typically renters. It's not a lot of buyers in that pool. And then obviously those with a bachelor's degree, you know, is only 4%, okay? So obviously the more educated you are, the more you have on that, okay? Now, this is really, really important, because don't get thinking about, oh, the economy's booming. It's not. It's not booming. There's a massive problem of people being unemployed. There's a massive amount of businesses that are going to fail. The reason why housing is doing so well is the demographics of a lot of people wanting to buy with low interest rates and a migration pattern. So don't like sell the great economy to everybody, because it's not the case. And I think we're going to start seeing that come by the end of the year. I think we're going to see some corrections. So as I kind of went over for you, a couple cool stats for you guys that I really am going to love in 2021. So Black Knight, biggest aggregator of data in the entire country. What they do is they basically call and survey 1,000 households a day. They gather in this information. So Black Knight, 21% more people are going to move in 2021 than did in 2020. We already had a big move in 2020, okay? Now, 72 million people are between 25 and 34 years old right now, and that's in 2021 and 2022. To give you an idea, at the same time 10 years ago, there was only 40 million people in that same age range. So that gives you an idea of how many more individuals with those birth rates in the late 80s to mid 90s are actually coming of age right now. So there's way more people now having families and wanting to buy a home than there were 10 years ago. So we need a greater supply of houses, because when we don't have it, I'm going to show you here in a sec. Now, home sales will be about 7% higher as far as sales go in 2021 and 2022. So I think we're going to hit probably pretty close to 6 million homes sold this year. Now, once again, mentioned it, 15% of individuals were working remote before COVID. Now, obviously, 30% will plan to stay with COVID. Obviously, more people working remote. That's great for Riverside County. It's great for other metro areas. Why specifically? Because people can live further away from their corporate office and still be able to have affordable housing, much more room. So those hot pockets here in each state are going to really continue to boom as this migration continues over the next 2 to 3 years. Now, this is some scary crap right here. Now, in January 2019, there was 1.6 million homes for sale, okay? 1.6 million homes for sale. Now, we know in January of 2019, there was not nearly as many people looking for homes, okay? Now, you didn't have people migrating, you didn't have quite as many buyers reaching home buying age. We had 1.6 million homes, okay? And the market was doing good. Now, in January of 2020, before COVID happened, we had 1.5 million homes for sale, right? We were just starting to the demand was going. We all felt it. It was the best start to really any year that I can remember in housing. Now, last month, we only have 900,000 homes for sale. Now, do we think more people looking to move right now or 2 years ago? Right now, right? 100% right now. Why? Because migration patterns, people can work remotely. We have more home buyers reaching home buying age. We have a lot lower interest rates and we have rising rents, okay? So we have a lot more people looking for homes and we have 40% less houses, okay? 40% less houses. Now, that is why we're seeing these crazy price spikes. Now, it's not going to continue forever that way because we are going to get more inventory on the market. Now, as you can see right here, there's an estimated 10% increase in individuals looking to buy a home than 2019. That means we have 10% more home buyers of that home buying age looking to buy a house and we have 40% less houses. Do the math. No wonder our prices are going through the roof, right? Okay. Now, a couple different things I want to focus for you guys, and I'm going to hit the last topic. Here's a couple states. I won't go through them. Here's the ones that are posed for the most growth for an investment in 2020 to 2021. Here's 10 states. I went in, put all that in. Then states with the biggest exodus, people leaving. There's no secret to that. Now, here's what I want to finish up with for you guys, and then I can open up some thing. Two things that I know are coming down. You guys are probably going to get a lot of questions about it. Biden now, obviously being in office, is getting pressure on two specific executive orders, which means he doesn't need, obviously, Congress and the Senate to actually approve them. The two that are being put out there is the student loan forgiveness and then the first-time homebuyer tax credit. I'm going to explain these to you guys. So, first off, when Biden was running for office, he was saying about $10,000 because the average student loan, like if you took all the student loans that are owed and you divide them by the amount of people that have student loans, about $13,000 per household of student loan debt. Now, that doesn't mean, now the issue is obviously most of those are really heading in certain areas. Now, most people that have the heavier student loan debt are the individuals that do have a good job, if they're, if they are having some, master's degree education or doctorate. So they are very, very heavy in that. Now, I got out of school with student loans and I just didn't go crazy and paid them off, right? So, I mean, part of it pisses me off that people are going to get loans forgiven when every other generation had to pay them off, right? But at the same time, they're trying to now say, hey, he's going to sign off on $50,000 of student loan debt per household, which the only reason why they're ever doing that is because they know if they're asking for $50,000, obviously the Democrats in the House, and they know Biden came out with saying he was going to forgive $10,000, they're kind of meeting in the middle with the GOP party, is obviously going to be somewhere around $10,000 or $15,000 in student loan debt being forgiven. Now, this really isn't going to do much because I'll tell you right now, most people that have student loans aren't even paying on them. They're deferring them. So there's already all these income-based repayment plans. So my personal opinion, getting rid of $10,000 of student loan debt really isn't going to do a tremendous amount of the economy. It may help a little bit out, but people that have $100,000 in student loans and they're saying, I'm waiting to buy a house until my student loans are forgiven, that's never going to happen at that amount. $10,000 will be the amount that I really truly believe the executive order will be done in, and that's where it's at, because that's what he basically ran on his campaign for, and they just threw a $50,000 out last week, I know, just for some pie in the sky number, so they look like they can meet in the middle. Now, the second thing I really want to talk about is the first-time homebuyers tax credit. So this is nothing new. Obama did this when he got in office in 2009. Now, one of the things that is super, why did Obama do it in 2009 is because we needed people to buy freaking houses. We had way too many houses for sale and not nearly enough people to buy them. So first-time homebuyer tax credit was a brilliant idea. Probably going to be, if it passes before inventory starts hitting the market, probably the absolute stupidest thing anybody has ever done. Why? Because think about it this way. The way they're going to structure this is not going to be a tax credit when you actually file your income taxes. It's going to be at the closing table. So what it means is very similar to down payment assistance. Whereas down payment assistance, the person doesn't actually get that money. It just goes towards their down payment. That's the way they're actually putting it together. They're going to give them a $15,000 tax credit. They actually can use it as part of their down payment and closing costs, is the way it's currently being structured. Now, this is not passed yet, but now think about it. If we have a massive shortage of houses on the market, and we have more people than ever that are wanting to buy houses, and we have prices going up at a rate that we have not seen in well more than a decade, what do you think is going to happen when you put a tax credit in place that will have a 1-year expiration? Like, you have to use this tax, because tax credits are only good for that year. Tax credit in place that is going to force all these individuals that is going to have to maybe taken a year more, 2 years more to buy a house, but they want this tax credit, all slamming them into the market at one time. Now, I could be a little bit biased, but I'm pretty sure that the house price, the average house price, at least here locally, say it's $400,000, if you get an extra 10 or 10%, 15% of the people wanting to buy a home with the inventory we have, what the heck are you think that's going to do to house prices when you have even more people with this lack of inventory? So if they get a first-time homebuyer's tax credit for 15 grand, guarantee you, if they don't wait till we get some more inventory in the market in the second half of the year to pass this, that $15,000 they're getting, they're just going to spend $20,000 more for that same home they would have got, without that tax credit. So they're actually net losing by 5 grand. Now, don't get me wrong, as a real estate agent and as a mortgage lender, you know what? I want to do more loans and I want to do, obviously more business. And the more people buying houses, the better. But I also, on the conscious side of things, you don't want the market to get so hot and be so miserable because we all have to work so much harder. Everybody knows it right now. It's way more offers, way more showing, way more property payment scenarios, all these things. It's way more work to get somebody in the house today than it was 2 years ago. You can imagine how much crazier that's going to be if this gets put into place. So yes, I do think a first-time homebuyer's tax credit can be great, but we do need to wait until the economy starts to putter down a little bit and then use this to spur it. We don't need to throw gasoline on a fire. Okay, that's the last thing we need to do right now. So people are asking about a first-time homebuyer's tax credit. It has not been signed in yet. Who knows if it's actually when it's going to get signed in. But with that being said, even if somebody buys a home and they get a first-time homebuyer tax credit, doesn't mean they can't take that tax credit on their tax returns. Just it means they didn't have that money at closing to use it in that way. It's not like they're going to lose out on this dramatic thing. So when you do get people telling you guys that or wanting to know that, please note that the student loan forgiveness is going to likely be around 10 grand, and the first-time homebuyer's tax credit, it will likely pass. You probably will be able to use it as down payment assistance, but I would strongly suggest if it's going to pass in the first 6 part of the year, is buy now, because you're going to be paying a lot more for that house when that comes in. So that's kind of some closing words when I kind of look at everything, and I try to give you guys some pieces of advice on certain things. So the first thing is on the listing agent side. If I was a listing agent, the biggest thing I would be doing right now and putting out content or doing my newsletters is sell before inventory hits the market, because there will be more inventory hitting the market. There will 100% be more inventory hitting the market. That inventory will be hitting the market the more shots we get into arms once these moratoriums end for forbearance and rent abatement, and that will 100% happen. Now, obviously, if they sell their home, they need to know where they're going to go, obviously, right? So they obviously have options. They can try to rent somewhere. They can obviously sell their house and try to buy another house. In any way, shape, or form, what is going to happen, if you really are going to get maximum dollar and you're thinking about leaving California or you're thinking about moving out of the area, 100% list your home in the first 3 or 4 months of the year, because you want to list while demand is at high and the supply is as low as possible. Now, obviously, as a buyer's agent, when you're dealing with this, now, do I think house prices are going to be lower than where they are today by the end of the year? No, I don't. What I do think is going to happen is I do think interest rates are going to be about 0.5% higher, which 0.5% higher in interest rate is like paying $20,000 more for a home, right? If I have a house a loan at $420,000 at, let's say, 2.75, and I have a loan at $400,000 at 3.25%, they have the exact same mortgage payment, right? So at the end of the day, if you're sitting down and you're trying to wait and figure it out, now the last thing you want to do is pay more for the house and at a higher rate of interest. But you're also limited, of course, on inventory, right? So it is that, I totally get that double-edged sword. But you do need to be educating your clients that we are going to see interest rates move back up, not super high, but they will get back to the pre-COVID levels once we actually start going on as an economy and start resuming things. Now, as somebody looking to buy investment properties, I am always a big proponent of buying something that is needed by everybody. What is that? That is starter homes. No matter where you are in life, a 3-2 home, is going to be the most ideal thing for a couple different reasons. One, you're going to capture individuals that are going to want to move to an area to look in and get their feet wet before they want to do it. Two, you're going to get people moving, downsizing. You know what? I can't afford my payment anymore. I want to go ahead and I want to sell my home, capture the market, and move into a rental, and I want to downsize into that starter home. I'm also going to go ahead and people retiring. They're going to want a single-story home, 3-2, go ahead and be able to move in just for one, health reasons and accessibility reasons. Then also first-time home buyers. What are they going to want? They're going to want to start a home at a 3-2. So if I was an investor, which obviously I am, what am I buying? I'm buying 3-2s in markets where I see massive migration patterns, because I think rents are going to go up a lot faster than house prices, because affordable housing is going to be very, very, very hard to get. And so I think from an investing standpoint, that would be a great route to go, is some 3-2s in markets with good school districts. I do not think in any way, shape, or form you're going to be able to lose, because they're always going to have appetites for those particular properties. And then The last little part I'll share the screen is here basically for investors. PriceWaterhouse Cooper, if you don't know them, they're the biggest accounting firm in the country. They pretty much do the who's who of every real estate investment and firm. Here's their top 7 markets they picked for investing based on for a long-term investing strategy over 10 years, where they basically think you're going to see a mixture of both house appreciation, rent appreciation, population growth, all of that. These are your strongest 7 markets. So Raleigh, Austin, Nashville, Dallas, Fort Worth, Chicago, Tampa, and Salt Lake City. So I know I kind of ran through all this. I'll obviously go ahead and share this with you guys. So, and then also too, one of the things that we're really rolling out, because I'm getting so much interest right now with so many individuals, with real estate agents really trying to make themselves and differentiate themselves. We're actually rolling out a formal like realtor partner program, where basically what we're going to be able to go ahead and do is kind of put something together formally for you guys as well. Besides every single month doing this content pieces, presentation pieces, contents that you guys can obviously share. And I'll be actually kind of sharing that and sending that around for you guys as well. And then also too, if you guys, you know, I tried to get this through for leave about 8 or 9 minutes left before I have to jump on another appointment. And I can open it up to questions. If you guys have any questions, chat them into the chat box. I got Michelle here and she can ask them for me.
So somebody's asking, what are your thoughts on Big Bear for STR investment buying at the top of the market right now?
So it's actually funny you say that. So one of my clients, they own a very Liberty glass company. And what they have done is they have bought a huge amount of properties in Big Bear. I've done a ton of loans for them up there. Now, here's the thing about STR. So I personally, for those of you in short-term rentals, obviously, here's the thing, my only somewhat thing about Big Bear. I had an STR in Big Bear. It kind of burned me a little bit. For the only reason is if you guys remember, we went about 2 or 3 years with no snow. Now with 2 or 3 years with no snow, you don't get a lot of the winter crowd. And then in the summer crowd, don't get me wrong, you can make decent money because mountain biking is starting to pick up under there. But personally speaking, I think it can be great if you also want to mix it in with using it for yourself personally. Now, I think Big Bear is doing fantastic right now, and I think it'll do really good for the next couple of years because people are wanting to really get back into outdoors. They're liking to mountain bike. They're liking to snowboard. It's one of the only things you can do right now. Now, don't forget, though, when the world opens back up, you're going to get people wanting to do other things again. They're going to kind of migrate to the cities for the fantastic food. So I think that if you pencil it out and you look at an occupancy rate and you use something more like, use a company called AirDNA. So airdna.com is a great way. And I would suggest using occupancy rates that were in like 2018, 2019. It's probably close to maybe 70% occupancy. And then just kind of look to see if it pencils out. I definitely think it could do well. The big thing that I know up there is the 5-bedroom market. That's what this client does, is he really focuses on getting 5 bedrooms because the larger properties is what people really want. There's just a ton of 2-2s and 3-2s up there. So I definitely think Big Bear can be a great market, but I also think you need to, plan to make sure that you're using the correct statistics, because I think it's getting heavily inflated right now because it's one of the only places to go. And we've gotten 2 back-to-back years of great snow.
Okay. The only other question is, can they get a copy of the PowerPoint?
Yeah. And then so what I'll do is, if you want to go ahead and you just send Michelle at modernteam.com an email. That's with 2 L's. Michelle at modernteam.com an email. She'll put this, she can email over this PowerPoint to you. And it has all the links and everything else on where I got that data for you guys. Sweet. And then what I'll be doing too is we'll be doing these once a month. And then next time, like this was my forecast for the market. Next time, I'm going to each kind of pick something in. So one of the next things I'm going to do is kind of some of the content and social media secrets that I've kind of developed over the last year that has really allowed, I get a ton of consumer direct traffic now. And I just made a conscious effort about a year ago to really kind of find my identity and really deliver consistent content. And it's really allowed me to kind of, put myself in a section of the market that's kind of uncontested. So I'm going to be really focusing this next section on teaching you guys really how some quick, easy strategies to kind of really grow your brand and stuff like that, with obviously mixing in any new program updates and all of that kind of stuff as well. So one more question, sorry.
Damien's asking, after the world opens back up, do you think the employees that are remote working will be required or forced to move back to be closer to their employers?
So the question was, if people, once the world opens back up, are employers going to force those employees to go back? To be honest, I don't think so. I'll be frank. I was very against people working remote for my company here. And honestly, I have found them to be far more productive. I think that for some of them, the commuting time, even though it's not great, was just, the act of having to get ready and do that. So certain tasks, like a lot of our processing tasks, underwriting tasks, all of those, the ability to have that kind of family life balance and be able, they end up working a little bit longer hours traditionally too when they do that. So I know myself, any of my people that are working remote and have done a great job, I'm not going to require them to come back. From a couple of the other big mortgage companies I know, they aren't going to require them the same way. From friends that I have in other industries, they aren't either. Now, not everything can work remote, of course, but I think anybody that is in kind of that home buying frenzy, a lot of the millennial buyers right now, and a lot of people in that age are typically really focused not on a trade, but really typically usually on some type of service related industry rather than a trade related industry. And those can be working remote. And company owners really like that. I mean, brick and mortar expenses are really, really high in a lot of areas. And so they found an ability to become more efficient with less overhead. I really think it's going to stay, and I think with Zoom and everybody realizing everyone kind of got forced to use Zoom at all one time. And a lot of people really like it. I like being in person with people, but I mean, you're going to get some to go back, but like everything I was reading, most of the employers are thinking about almost 30% of the workforce can have the ability to work from home, which is pretty cool.
One other question. Is real estate or crypto your number one?
I'm assuming the question was, is real estate or crypto my number one? So I look at a couple things. That's actually a good question. Is I myself, with my own portfolio of, let's say, my own money and stuff, I am pretty well balanced. Like, just kind of like people asking if, let's say, let's just say you took my net worth between real estate, stocks and bonds, cryptocurrency, and let's say, investments in other companies outside of this one, of course. So I'm pretty well balanced. Right now, crypto makes up about 20% of my position. Real estate makes up about 30% of my position. Stocks and bonds make up about 15%. And then the other 35% is investments in other companies, things like alcohol companies or, different types of service companies, nothing related to the mortgage side of things. So crypto, I think, is probably the biggest upside, but it also too, for me, being in finance, I'm just really, really fascinated. And I see firsthand how bad the United States and other countries manipulate the currency. As I've been fortunate enough to kind of get in some higher wealth circles, I see things open up and I see the manipulation that is done. And now with the adoption rate of cryptocurrency, I think in America, we are so blinded to think that 300 million of us rule the world. We forget there's 7 billion people out there and we make up a very small portion of it. And so just because things are a little bit easier and our money works a little bit better here, we don't think that certain things are needed. And I think COVID and a lot of the Wall Street stuff really opened up people's eyes because they sat at home. And so once your eyes are opened, you can't really. So I am very bullish on crypto, but I don't sit there and I buy the same amount every single day at the same time, and I've done it since then. So I don't believe going all in any one thing. So I think a diversified portfolio is a good way to go. And all my stocks and bonds, pretty much, they're really heavily based in like gold and silver and cannabis. That's kind of where I hold most of it. So hope that gave you an answer.
Is it too late to invest in crypto?
Is it too late to invest in crypto? Absolutely not. The best way I can explain it is this. So Amazon went live, I believe they went on this New York Stock Exchange in 1996, right? And in 2003, the stock price had gone up 3,000%, right? So somebody looking at that stock, I don't remember the exact dollar amount when I looked at it, it's like $300 or $400 a share, right? Is what they were up to. And if somebody asked you back then and said, hey, you know what? Amazon has gone up 3,000%. It's $300 a share. You know what? That's crazy. I think I missed out on the boat. And now you look back today and you see where Amazon stock is and what it's done. Did you miss out? Yeah, you missed out on the first gains. And yeah, you wouldn't have made as much money as somebody that got in really early. But for the long-term play, absolutely not. It's not too late to get in. You can never time the market though. That is the biggest thing that I have learned. And I really spent a lot of time studying trading. And one thing I've learned is you can try to predict the market, but you know what? You just can't. So what I always say is you have to think of Bitcoin and Ethereum as not a speculative asset. You have to think of it as something that is going to hedge against the value of the dollar going down. So if you think about things like when you compare the cost of something in dollars to the cost of something in Bitcoin. So we just think about, oh, let's put dollars in Bitcoin and Bitcoin goes through the roof. You got to think of it the other way. Me moving a lot of money into Bitcoin over the last year, when I compare what Bitcoin is to, let's say, the cost of a house or the cost of a car or the cost of lumber or the cost of oil, right? Like the cost of lumber has gone up 50% to the United States dollar. Well, the cost of lumber expressed in Bitcoin has actually gone down. Why? Because Bitcoin's gone up a lot faster than lumber. Now, you're not going to see those gains for all of mankind, but what people don't realize is there's been two really big things that happened with Bitcoin. Is one, when Michael Saylor with MicroStrategies announced that he was moving almost all of his cash position of his company's balance sheet, a publicly traded company, into Bitcoin. People thought he was a lunatic, but this dude's like one of the smartest guys on the planet, and it took him for 20-something years to acquire $400 million of cash for his business, and he knew keeping it in the dollar, as the dollar was keeping the print, was going to fall. Gold wasn't going to do enough. So he moved it into Bitcoin, and it killed it for him. And then you had Elon Musk move 7% of Tesla's cash last month into Bitcoin. And then what did Michael Saylor do this last weekend? Michael Saylor gathered 50 of the top CEOs that wanted to, because you can imagine, they're all contacting him because they all have shareholders and be like, hey, dude, cash is dropping in value. I have all this money right now. What should I do with it? You know? And so Michael Saylor ran a summit for about, I don't remember the exact number, so don't hold me, 30 to 50 of the top CEOs that reached out to him in the country and showed him how to properly allocate a certain portion of their cash into Bitcoin to help curb against inflation, or the value losing of the dollar, of the value of a dollar losing itself, right? Because every year your dollar is worth less, okay? So with those type of big players coming in, this is just the beginning of it. Now, do I think Bitcoin's going to be $200,000 by the end of the year? No. Could it pull back to 30,000? Yes, of course. All those things could happen, but that's why you buy the same amount every week or every month at the same time, and you use it as an investment. You don't try to speculate on it. Cool. Sweet, guys. I appreciate it so much.